Hello, everyone. Welcome to the final bar. Today, I'm joined by Mark Young from WallStreetSentiment.com. Thursdays are a big sentiment day, so it'll be interesting to see what the sentiment has been leading up to today. And then I think we're going to talk a little bit about where sentiment might be evolving with the S&P down heavily, really coming out of the gates pretty low. And this is after some of the bearish engulfing patterns, some of the weakness we talked about yesterday with Apple, maybe one of the more obvious examples. So during the course of the show, we're going to try to unpack this pullback today, see if it has potential staying power and where to identify some objectives on the downside. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close to unpack the activity of the day through the lenses of technical analysis, behavioral finance, trying to think about what other investors are thinking. And on a day like today, who better than someone like Mark Young from WallStreetSentiment.com? Really, his practice, his toolkit is essentially trying to understand where investors are leaning in and leaning out, and what they're voting with their feet, what they're voting with their words. And we're going to talk about a pullback and how that fits into the bigger picture discussion we've been having. We've been talking about the signs of internal market weakness. We've been talking about a lack of confirmation from breadth, weakness in places like mid caps and small caps, breadth lines rolling over, equal weighted S&P making a new 52-week low this week. And as we've talked about, it wasn't today, but at some point we start getting a pullback. And that's certainly what we saw today. So the question, on this sort of environment is, how does it relate to the long-term trend? What sort of triggers have we seen? And that's what we'll try to go through the course of the show today. Excited to have Mark Young on the show today. Next week, coming up on the final bar, we have Fred Meisner joining us on September 9th from the Fred Report in Atlanta. And then David Settle from Market Scholars is going to be joining us coming up on September 15th. Our next big event is coming up on September 22nd. That's called Introducing StockCharts ACP. We've been capturing some fantastic interviews with people like Larry Williams, Ralph Acampora, Martin Pring, Chip Anderson, Grayson Rose, and I from the StockCharts team are going to be sharing the latest iteration of StockCharts and a lot of really cool plugins that will allow you to hopefully understand the market dynamics a little better. As a reminder, we're going into the long holiday weekend, so we'll be taking Monday off for Labor Day, and we'll see you back here on Tuesday after we all lick our wounds from what apparently is going to be happening this week to all of us. Let's get on to our market recap. So as I'm sure you're aware, certainly distribution today and in a way unlike what we've seen in quite a while. So this is certainly going to be a bit of a discomfort relative to the trends that we've seen, but let's try to pay attention to the forest for the trees, understand how today's sell-off fits into the big picture. Just to orient ourselves, the S&P down 3.5%. That's below just around 3455. The NASDAQ composite really led the way down, but the NASDAQ 100 down over 5%. Technology was the weakest of the 11 S&P sectors, down pretty significantly, over 5.5%. VIX spiking up over 33 now, and this is a 25% rise in the VIX from yesterday's close. So we had extreme, essentially long-term lows in the VIX, and that reverted very quickly as volatility has increased. Let's look very quickly at some of the other asset classes. The bond market appreciated, really rallied through the morning session, sold off toward the end of the day, up 0.25%, and 10-year yields down just a bit. On the commodity side, gold down 0.8%, silver down 3%. So it wasn't a rotation back to the safety trade by any means. The only assets that were up. If you consider the dollar up, it was essentially flat for the day. If you look at the UUP, bonds were the only thing that were up, and not by much. So overall, it was certainly distribution essentially across the board here. Let's spend some time looking at the daily chart of the S&P. So, as a reminder, it's very easy when the entire screen turns red to start thinking of climactically bad things. And I'm not going to tell you that we don't go materially lower from here. That may happen. But again, on a day like today, it certainly feels like things have gotten very weak very quickly. As a reminder, we're still above 3450. We're still above 3400, which is where we were just a couple weeks ago. So while this is certainly distributed, while in the short term, it certainly speaks to the strength of the selling coming out of the extreme overbought condition. That's all stuff we talked about coming up until today. It shouldn't be too much of a surprise, even though it's surprising on the day it happens. This is something that should, be part of your expectation. Is during an extended uptrend, you need days like this, you need moves like this, even if this is a little more severe than what we've seen in quite a while. So, as a reminder, what we talked about, even up until yesterday, was the S&P extremely overbought. That means it's up a ton. Base case is you get a pullback from those extreme highs, usually get at least one more move higher, and that's because the S&P is extremely overbought. In my experience, that means, the momentum on the upside is so strong, at the very least, after a brief pullback, you'll get a little bit of a move higher, one more final push. And that usually is where you end up getting things like bearish divergences, where you get a lower peak in momentum as the price takes one more gasp higher. So arguably, we're in the first sort of distributive pattern of that. I think it's too early to be, necessarily, deciding whether or not this is a long-term sell-off or a short-term sell-off. The way that you do that is by looking at key lines in the sand. And that's a phrase we haven't talked in a while because we haven't needed them because the market's been going up. But, for me, it's always about where we're at. You look to the left and you look for key support levels. So, I need to update this chart, and forgive me for not doing so before now, but the first big level I'm looking at is this 3350 to 3400. That takes the peak that we saw from February. That's the peak that we ran into in early to mid-August. We then eclipsed that, and that break above 3,400 was pretty significant. So getting back to that area and seeing whether we're able to hold that and rotate higher, or if we break it, that's sort of the first line in the sand on the S&P. And on a lot of charts, Apple and Zoom and others that have gone vertical and now coming off, you need to look for that sort of level, sort of that first pullback and where we're looking for support. If we would break that, I think the next level I'd be looking for is down here in that 3,200 to 3,250 range. That's a pretty meaningful drop from the peak. So even though, on the chart, it doesn't look like a lot, that's, to be honest with you, it's sort of all relative, right? So if we start there, that's a 10, 12% drop if we get into that, 3,200 to 3,250 range. So that's a pretty meaty drop from the peaks. So the good news is we're already, a good ways the way there, down 4% off of the highs. So again, I think it's the important time to recognize that, this is one day among many. So let's pay attention to key levels, key trend lines, and see what holds and what does not. I don't think I'm super surprised by this, given the breadth conditions, all the things we've talked about. And now's the time to identify those levels at which you'd reduce positioning or plan for the potential for further downside. Now, having said that, let's look at some of the other information, see what conclusions we can draw. So in terms of what worked today, not much, to be honest with you. Pretty much everything was down. The things that performed the best on a relative basis were energy, utilities, financials. And I noted as I went down there, things like DFS, Discover Financial Services was there in the top 10 for scooter gainers. That means they gained on a relative basis relative to other stocks, other groups. We're going to look a little later. We're going to do a segment called "It's All Relative." We're focused on some of the groups and some of the stocks that we're able to hold up okay today, and that might be an interesting group to look at. On the downside, you had technology certainly leading the way lower. After that, it's pretty much the leadership we've seen up until today. Things like communication services, consumer discretionary, industrials. We talked about industrials yesterday. We did a deep dive in the sector and look for opportunities of things that were breaking out, that were looking fairly constructive. Within there, it's actually interesting to see airlines as one of the better groups today. Again, on a relative basis, down with most things. Actually, it looked like it was flat for the day there. Just above the zero line, but as a handful of groups that were able to hold up. And again, a little later, we're going to dig into those names a little further. A lot of the names that you see in the top 10 really started to come off a little bit. I just want to start there, just looking at a couple of things. So, Apple, Tesla, Zoom, these are three that come to mind. Yesterday, we talked about this bearish engulfing pattern. And to be clear, what a bearish engulfing pattern tells you, it's a short-term candle pattern. We have an up day and then a down day where the second day's body engulfs the first day. You can see it okay on the bar chart. It's really meant to be looked at on the candle chart here. So let's look just a little shorter time frame here on Apple. You can see a little clearer. So this is what we're talking about. The up day, the down day, and the second day's real body open to close engulfs the range of the first day, day one. An idealized version would have a stronger up day on day one, but I think this counts. And so if you think about what happens, we closed up on day one. On day two, we gapped up in the open, but by the close, we've gone below the previous day's open. And so it really represents a short-term reversal. It's a short-term candle pattern. So it's really meant to just tell you about the next couple bars, but certainly leaning more weak and weaker rather than strong. When you see today, again, Apple down 8% pretty significantly. Zoom is a name that a lot of people, if you'd not paid attention to it up until a couple of days ago, probably picked up on your radar, because a gap from 320 up to 460 one day, the next up over almost 50% just on the day. And so that sort of move tends to be extreme, and the question always is, what's the follow through? Yesterday we sort of came down, and now we're back down another 10%. So it's quickly retracing a lot of its gains. On something like this, the lower end of that gap around 320 is certainly where you'd be looking for significant support, because that's where sort of the breakout started. That's where you'd want to look for. So the situation that we've seen, again, I want to get into as many other charts as we can, and a little later we'll do a segment, It's All Relative. We'll focus a little bit more on some of the fallout from today's sell-off. But I want to take a quick commercial break. We'll be back with my guest, Mark Young. We'll see you in a minute. Hello, everyone. Welcome back to the show. This is Dave Keller here at StockCharts.com. As a reminder, we love to hear from you. Happy to answer any of your questions on stock charts, on technical analysis, on particular tickers or themes, groups that you're looking at. Just shoot us an email. thefinalbar@StockCharts.com is the best way to get a hold of us. We're also getting more and more questions via Twitter, and just tag us in a comment at FinalBarSCTV. And again, we'll gather all of those and we'll answer as much as we can in our mailbag segment coming up tomorrow on Friday of this week. I want to welcome on my guest to the show for the first time, Mark Young from WallStreetSentiment.com. Mark's coming to us from Northern Kentucky, Covington, Kentucky area, just outside of Cincinnati, and has contributed some content through StockCharts, the Top Advisors Corner. Also done a lot of work with Carl and Aaron Swenlin, so I've seen his work there, and I've enjoyed getting to know his perspective on sentiment. So, Mark, welcome to the show.
Well, thanks for having me, Dave.
So you sent two charts ahead of time. It's a great time to have you on, because obviously a big sentiment day on Thursdays with with a lot coming out in the last 24 hours. But now we've seen certainly a change in sentiment in the form of the VIX, right? A spike in volatility. Start with the first chart. What is this telling you?
Well, interestingly, coming into today, I was kind of alarmed by the fact that the VIX was going up as the market was rallying. Normally, it's an inverse relationship. As the market rallies, the VIX falls. And I've been thinking that's sometimes a tell for a dramatic event to come. Obviously, today we had a dramatic event, so I guess that's still a pretty decent tell. But what's interesting here is that spike in the VIX is dramatic. While the decline was certainly exciting and maybe scary for some people, when you get a big spike in the VIX like that, it's fuel for a future rally. This sent the relative VIX, which I follow, up to, I believe, 124, which is rather high, and that's generally a marker for some sort of a low. And it doesn't have to be pinpoint, but within a few days, maybe a week, unless something dramatic has changed in the market. So immediately here, as has been the case, our declines are being met with a spike in pessimism, and that's usually a tell for a market that's not ready to give up the ghost, at least not just yet. Subject to review as they turn over more cards, as we see the breadth. We knew breadth was a problem. We knew the market was way overextended, but in the current environment, premiums on options are very high, and that allows investors to buy, say, the S&P, short the futures against it as a hedge, and then sell the options for a near risk-free return. It'll be a variable return, but it's up when the VIX is this high, the return on a buy right, buying the underlying and selling the options against it, that return is substantial. And that's just the simplistic way of doing it. Some of the people playing in this arena, with the programming skills they've got and the capital they've got, this is just making them smack their lips. It's a huge amount of premium. They can do all kinds of custom, curated little portfolios that they can do buy rights against and hedge against, and take very little risk, use a tremendous amount of leverage, and get a very nice net of net return, especially when they can borrow money so cheaply. I think commercial paper is only yielding about 15 basis points. That's almost not enough to warrant writing up the paperwork. So those guys are undoubtedly borrowing and doing these option plays. The only thing you need to worry about is if your options got too far in the money, then you'd want to take your hedge off, I suppose, or roll the options forward. But that's a pretty dramatic incentive for more money, even more money to flow into the stock market. And there's money out there.
It's a really interesting point, Mark, and I especially, as you were describing this move, that it tends to be, overall tends to be bullish for stocks. I can't help but notice the similarities to what we're seeing right now versus what we saw in mid-June as the S&P sort of got into that interim peak, and you had the big down day, the big spike in the VIX, and that ended up being a pretty decent time to buy for the next move higher. Now, we only have a minute left, Mark, but I did want to get to your second chart, looking at sentiment in the form of the AAII survey. I know that just came out this afternoon. Give us a sense of how this relates to what we're seeing this week.
So one of the reasons I'm not overly concerned is that we don't see very many bulls at AAII. They've got new numbers out, but there's still more bears than bulls. And if we are going to see a top of some significance, I would normally expect to see the bulls, north of 40%, at least at AAII, and really higher than that. I'd love to see a 2-to-1 bull to bear ratio. We aren't anywhere close. Those guys are still pretty bared up. That suggests to me there's still plenty of money on the sidelines. And at least it leads me to want to be more optimistic over the coming several days and looking for an opportunity to do some buying.
It's really interesting. And I think, I can totally see where you're saying, where there's if you look at historical market tops, certainly seems in general, there's much more of a bullish feel to the AAII readings than what we're seeing today. And I think most notably looking at the relationship between the two, right? Bulls versus bears, which is right. Relatively, if you look at the long-term history, this is relatively still at a very low level, right?
Exactly. It's, this isn't a fail-safe, but boy, it's certainly implying that there's not as much bullishness as you would normally expect for there to be a major market top.
Mark, this is all the time we have. I wish we could talk for an hour, because I'd love to continue to pick your brain on this, but we'll have to settle for having you back on again soon to debrief on your looks at sentiment. Mark Young, thanks so much for coming on the show today.
It's absolutely my pleasure.
It was Mark Young from wallstreetsentiment.com. And again, I've enjoyed so much getting familiar with Mark's approach. And for me, I've always thought, as we've talked about, I've thought about a macro analysis as having three parts: price, breadth, and sentiment. And while I will always lean into price as the main indicator, right? What are the trends? Breadth and sentiment can do so much to help you understand really the dynamics behind the price, what's driving buying and selling decisions. So interesting to see a little more of a bullish, overall takeaway from Mark looking at the sentiment indicators. Our next segment is called It's All Relative. We talked about some other segments today, but given the distribution today, I just wanted to focus on some of the places where we are seeing relative strength, some of the groups that are able to hold up okay, and also just focus on again, a little bit on some of the big tech names that have come off. So we sort of rush through things like Zoom, and I just want to come back to that very quickly and point out that there are plenty of charts like Zoom, like Apple that we talked about. And again, I think what's most important now that you've had a bit of a sell-off is look to the left and see what key levels are in play. And I think with something like Zoom, again, the challenge is from where we're at today, closing around 380 to the top of this gap, I know that's 320, which is another 60 points down. That's a pretty major move, but given the gap, given the move, that's from a technical perspective, I think that's what you have to be looking for in terms of downside support. And if we're able to hold that, then it makes a lot of sense. Tesla is obviously a name that many are familiar with, and many have been following. Just to talk about this, down another 9% today, and again, it's come from 500 down to 400, just above that. So it's down 20% just in the last couple of days. So stocks like Tesla feel much more like cryptocurrencies in terms of the volatility and the percent swings that you're seeing just on a day-to-day basis. But again, I think there's still there's value to be had by looking at the charts and understanding the dynamics there. If you think about it, this is similar to what we talked about with the S&P 500, where a lot of these names were extremely overbought just recently. Just a couple of days ago, when it reached 500, you saw that that the RSI was extremely overbought, and all that means is it's gone up a lot. You saw that back here in early July, actually, right? And the price actually ended up going up a little further. That's where you start to get divergences with the price going higher, but less confirmation, less momentum. So potentially that's what you'd be looking for. Here is at some point buyers come in and rally a bit, and then you look to see if we get a lower peak in the RSI. Most often you do, and that usually ends up being more of a longer term top if you get that configuration. For what it's worth, this is actually called a gravestone doji candle. We have the open and close right almost at the exact same level, then a long upper shadow, a minimal lower shadow. Tends to be a short-term reversal pattern. So for what it's worth, getting a bit of a short-term bounce signal on Tesla as of the close today. We'll, again, have to see what happens. The challenge with the Tesla chart is it's difficult to find any clear support levels, only because we've rallied so much from here. I don't have the Fibonacci retracements. That's one thing I'd certainly look at. The problem with the Tesla chart is really 275 is the key support level. That comes a lot lower than where we're at. It's another 130 points below, 140 points below where we're at. But what I'll also point out is the 50-day moving average, which is right about here. So there's a little more downside from a technical perspective just because of the rally that you had going into those peaks. Let's talk a little bit about some of the groups that have done well. So energy, the number one sector, utilities number two, financials number three. I thought it was interesting to see DFS on the top 10 list. And when I'm saying the top 10 list, it's not top 10 gainers. This is top 10 stocks using the scooter ranking. So this is the StockCharts technical rating. It's a ranking system for different universes. So we have the large cap universe, which is what we're doing here. So above the chart, I actually show the scooter ranking here is 39, which means 39th percentile. You take the whole large cap universe 1 to 100, and that's the range. We have a separate universe for mid caps, another one for small caps, another one for industries, another one for ETFs. So depending on what you're looking at, it's going to compare the technical configuration, essentially the trend strength relative to all the rest of the tickers within that universe. So relative to other relative to other large cap stocks, DFS is only in the 39th percentile, which is not ideal, but it's one of the biggest gains today. So this was up over 3% on a day when stocks are down. One of the things I've often looked at is on a big down day, what actually managed to hold up, was up or wasn't down too much, right? What actually held up? Where were people still remaining while they were selling off in other places? And DFS sort of fits the big Comerica, if I remember right, just from a moment ago, was on there as well. So, on a chart like this, it's actually fairly constructive in terms of the overall pattern. What the problem with something like DFS is it's not broken above the key resistance, not followed through resistance. So right now you have resistance here just below 50. I'm going to probably call it 56 or so, which is the closing prices right around there. We're just around 55.40. So if we're able to close a little bit further and get, close a little further above these gains and then follow through above the 200-day moving average, that's what I'd certainly look for. The challenge with DFS is the RSI is still sort of in that bearish range, really in the neutral range. It's gone between 40 and 60 and has not been able to really stay above 60. So if you see it break above the 200-day, the RSI break above 60, the relative strength break to a new high for the last couple of months, that would be a little more constructive than what we've seen so far. CMA, Comerica, that was the other one that we saw. Kind of a similar pattern, but a little earlier on. Again, the challenge that you see right now, if you look at what stocks work today, there are patterns like this. They're not great long-term patterns. They're sort of okay. They're neutral. They're sort of consolidating. In this case, if you look at the long-term pattern of Comerica, lower highs, higher lows, sort of consolidating around the zero level. And so for here, you'd want to see a break above 42.50, which would get us above the closes there from early August. So the challenge looking at some of these charts today is that it's not a great setup relative to the longer term trend. The XLU and utilities was one of the top sectors today, and I think again the challenge with utilities is that we haven't seen enough of a follow through on price on a relative basis. This is the spike that you've seen just in the last couple of days. I don't know if I'd call it a spike, just the improvement in relative strength, but the long term trend is still negative. So I think getting back to what my guest Mark Young was speaking at, it's very easy to look today and start to draw some longer term conclusions on it. I don't think it's too soon to be thinking about downside risk, to be looking at longer term support levels and what you would need to see on the chart to decide to take profits or to cut your losses on positions that may be under pressure right now. But I think it's a little too early to consider this a huge upswing for utilities, because on a relative basis, again, the longer term trend is still fairly negative. Just to finish up, I want to highlight looking at the weekly chart here. This is the long-term trend. Tomorrow's show is where we'll wrap the week. We'll spend a little time looking at the Mindful Investor Live chart list. We'll look at this chart among many others, but this is looking at the trend of in the markets on the weekly chart, long-term, medium-term, short-term. The short-term trend, which is just looking at the price versus the 5-week exponential moving average, one of my base cases of just short-term uptrend or downtrend. It's still above that. So again, even with today's sell-off, you're still within the context of a longer-term trend. So again, now is the time to look at your charts, look at the final bar, look to the left, and identify some key levels. You make sure your stops are updated and identify when you want to start to get out of or take some profits. We need to wrap the show. Go right to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is looking at the breadth in the market in the form of the S&P and the percent of stocks above their 200-day and 50-day moving averages. And sorry for the charts loading a little slow. I feel like all school children in the town we're in, along with probably many of you, are going back to school and streaming some educational thing on Zoom or something like that. So sorry we're doing the best we can given the conditions. But looking at the S&P and the breadth, percent of stocks above their 200-day, this is not quite updated for today yet, but someone made a comment on Twitter. It was something that I posted on, look, still over 80% of stocks are above their 50-day. And that is absolutely right. Even with today's sell-off, a lot of stocks are still above their 50-day moving average. That's not going to go to zero today by any reason. But I think for me, when you think about a pullback, the way that you keep your sanity and make sure is looking at longer term indications of trend reversal. So for me, one of the longer term breadth conditions would be over 50% of stocks above their 200-day. If you think about the S&P is still way above its 200-day, that's 350 plus points away to get down to 3090, which is where the 200-day would be. That's a 15% sell-off in stocks to get down there, and a lot of stocks are even more extended than the S&P has been. So that remaining above 50% tells you that the overall longer-term trend is still positive. We're in no jeopardy of violating that anytime soon by my read. Chart number 2 is similar to one of the charts that Mark Young showed, looking at the AAII survey. And again, I'd echo what Mark had pointed out. It's the spread between bulls and bears still favors bears over bulls. We had a little bit of a pullback in bullish sentiment, a little bit of an increase in bearish sentiment. So 42% of respondents bared up. But if you look at where we're at relative to historical bull market cycles, the level of bullishness usually can get a lot further than this, and we're still only around 30% of respondents. Finally, I'd point out the stock versus bond ratio. Bonds actually held up okay, and this ratio has clearly been favoring stocks over the last month or so. But if you look at the last week, we're starting to see, and this is today with the big pullback, you see the ratio starting to turn lower a little bit, especially with how much stocks have run, especially with the strength in a lot of individual names over the long term and how much they've appreciated, overvalued by most measures I could come up with. Keep an eye on this ratio, and just from an asset allocation perspective, thinking about where you're looking at stocks versus bonds and whether it makes sense to have a little more allocation on the fixed income side. This might be a good chart for you to make sense of that rotation. Folks, that's our show for today. I want to thank my guest, Mark Young from wallstreetsentiment.com, joining us. Pleasure to have him on the show, and we'll look forward to having him again on soon. Get your questions to us. We'll do another mailbag segment tomorrow. The final bar at StockCharts.com is the best way to get your questions in front of us. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.